Madelyn, and I am the Deputy Vice Chancellor of NYU Abu Dhabi, and I am very happy to welcome you to 19 Washington Square North. You are the first event that we are having in this building, so this is a momentous night, and as I told you, we sat here waiting for our audience, and so we are especially glad to see you filling the seats in our brand new event space. 19 Washington Square North is meant to be a conduit connecting NYU in New York with NYU in Abu Dhabi. And this program is exemplary of our aspirations for the public lectures and conferences and workshops that we have in this building from tonight onward. That it draws in faculty and students from NYU and engages in conversations about topics of relevance in New York as well as to our programs in Abu Dhabi. Our program tonight is being videotaped, and it will be available to our growing university community in New York. I'm delighted that the provost of NYU Abu Dhabi is just in from Abu Dhabi tonight. That is Marriott Westermann. And I would just like to acknowledge as well the extraordinary work of Carrie Barrett and Alana Barrage, who, with others in our office, who I don't, in Diane Chester in the back, are part of the team that is turning this building into a dynamic hub. There are many other activities that will take place in this building, including video conference seminars in the video conference room just down the hall. And we anticipate having classes here that are linked to classes in Abu Dhabi, as well as other kinds of meetings and curriculum development workshops. The convener of tonight's panel, Paul Wachtel, who I know is known to you all, has been a leader in building the curriculum and in recruiting the faculty for NYU Abu Dhabi. It is at its core a college that will next year open to approximately 100 students, and a program in economics will be undoubtedly one of the draws of our curriculum, and we thank Paul for his help in developing that program. We are also delighted that one of the lead-off faculty in that very important inaugural year will be Professor John Leahy, who will be teaching for us in Abu Dhabi, and we are absolutely thrilled that he is doing that and is with us tonight. Paul Wachtel, you know, is professor of economics at Stern, and he has been, as I say, one of the great builders of our program. So we were very delighted that he would take on the responsibility of convening tonight's panel, and I turn it to him for the introductions. Thank you.
Thank you. You know, it's my pleasure to be here this evening to inaugurate activities in this building, and I hope this is the first of many interesting events which will be held here. When Hillary first suggested that I do something on the crisis, I said, oh, it's a timely sort of thing, and looked forward to convening a conversation, as I called it. I didn't want to have a speech, I didn't want to have a panel discussion. I wanted to have a conversation with some friends of mine, and I'll introduce three very good friends of mine who will participate in a conversation this evening, which I hope you'll join in as well on some very, very important issues. Now, the downturn of 2007 to 2009 was, by all means, the most serious economic crisis since the Great Depression in every respect. The depth and length of the contraction in economic activity, the near collapse of the world financial system, and the extent to which the crisis has reached every corner of the world. Now, prior to the crisis, macroeconomic policy seemed to be working just fine. Inflation had disappeared, trade was expanding, and sustained economic growth was found all over the globe. However, the crisis has led to some profound questioning of the way in which we conduct economic policy, particularly with respect to financial regulation, and calls for reform are common. But what exactly these reforms should be is a difficult question for which there are no clear answers. Simply, what can we do to make sure that this is a once-in-the-century perfect storm that does not take place again, at least not in this century or our lifetimes? it would be misleading to say we'll come up with a solution this evening to keep these things from ever happening again. We've been around long enough to know that they do happen again, but let's see if we can figure out ways to sort of put it off for at least a century or so. Now, forecasters tell us that the trough of the recession probably occurred in June and July. So as bad as things seem out there out the door, they're probably improving. However, little has been done to change the rules of the game. Our purpose this evening is to keep the debate alive. We as citizens need to make sure that a busy Congress, a worn-out president, and a defensive banking industry do not just drop the ball and leave things as they are. Even if the Dow roars back to 15,000, there still will be lots of important things to do. So I would like to start a conversation about these things with our panelists, and let me introduce them. Starting with Madelyn Antoncic, who's alphabetically first, and I think one of the three that I've known the longest, because Madelyn did her PhD at what was then the Graduate School of Business Administration of New York University before it became the Stern School of Business of NYU. And after she finished at NYU, she went to the Federal Reserve Bank of New York, where she served as a research economist. Went from the Federal Reserve to 12 years at Goldman Sachs. From there to a 2-year stint at Barclays Capital as head of market risk management. And from there to Lehman Brothers, where she served in a number of roles, helping them build their risk management activities, a role she left well prior to any of the problems that emerged at Lehman. And served in other roles at Lehman until recently. She was instrumental at Lehman in developing their business activities in the Middle East and is quite familiar with Abu Dhabi and other places around the Middle East from that experience. So I welcome her here to be with us this evening. Next on my immediate right is John Leahy, and as Hillary said, his most distinguished academic appointment is as an affiliated faculty member of NYU Abu Dhabi. But he does have some other relatively distinguished academic appointments as well. After he completed his PhD at Princeton, he served on the faculty of Harvard for a number of years, and then came to the Department of Economics at NYU in 2002, where he's a distinguished member of that faculty as a macroeconomist. Finally, on my far right is Kim Schoenholtz, who is presently an adjunct professor at the Stern School of Business at New York University, having come to the Stern School from a long career in the financial community, starting at Salomon Brothers in 1986, spent time with Salomon in its Tokyo office, spent time with Salomon in Europe, stayed with Salomon as its name changed in various ways, ending up as the chief economist at Salomon Smith Barney and at Citigroup as they took over the company. He's an expert on emerging market economies and the financial industry, and as I said, is now teaching for us at the Stern School, and we're very, very proud to have him on our faculty there. So I'm going to continue with some questions which are designed not so much as questions, but as a means of getting a conversation started. And we can start with the sort of origins of the crisis. As I noted earlier, the crisis of 2007, 2009 was a perfect storm, where several things came together at the same time to almost swamp the boat altogether. The perfect storm analogy might not be so great, because in that book and movie, the boat actually sinks, and the fishermen are lost. We didn't quite get to that extent of a problem, but we came damn close.
We're not over yet. I said it's not over yet. We'll see.
Mariette was worried about this being a discussion of the dismal science. Here we are already. Now, the things that came together for that perfect storm, amongst the things that came together to create that perfect storm, might have been mistakes in macroeconomic monetary policy at the end of the Greenspan era at the Federal Reserve. The Greenspan Fed kept short-term interest rates perhaps too low for too long. The Fed funds rate was below 2%, was 2% or less for 3 years, from the end of 2001 to the end of 2004. Another possibility is some of the institutional developments, particularly in the housing mortgage sector, the expanding authority of the government-sponsored enterprises and their increased level of activity, the development of the mortgage-backed securities market and for subprime mortgages beginning in the mid and late 1990s, and other things as well. And finally, perhaps a failure of risk management in the financial industry, where there's some misunderstanding of some of the tools of risk management, like value-at-risk models, and perhaps some misuse or misunderstanding of ratings agencies and their role in the financial industry. I'm not sure how the history books will discuss each of these issues, but there might have been some critical elements of these issues or others which really were, which we might think the history books a generation from now will really look back and point their fingers at and identify as the critical issues or the critical decisions that started us on the way towards the perfect storm. So let me ask anybody to start off. Madelyn, since I started with you, I'll let you begin. What would you think might be the critical things that the history books of the next generation are going to emphasize when they talk about the perfect storm of 2007, 2009?
I think you sort of touched on, with the Fed funds rate story, you sort of touched on one of the key, in my mind, culprits for what happened was that's excess liquidity. We saw the excess liquidity not just with respect to, the funds rate, but if you look at the twin deficits, I think really caused, a large part of the problem by having so much money sloshing around the system. Of course, China, with the very aggressive policies, also contributed to that excess liquidity. And of course, the demand that resulted from the economic engine caused, the price of oil to keep rising, and of course, the price of oil to keep rising added excess liquidity again in the Middle East. So you had, three very large sources, in my mind, of excess liquidity, which to me was sort of first and foremost in terms of the contributor towards what happened. I think if you really peel back, you touched on sort of the GSEs. I think the GSEs, that mandate has been around since their existence. And one of the things that I did when I was at Goldman was I traded mortgages. And one of the things that I never could understand, even in the 90s, was how it made any sense that you had institutions like Fannie Mae and Freddie Mac, Fannie Mae in particular, which was in some ways, part of their business was obviously originating mortgages or helping to originate mortgages. Part of the business was really managing a portfolio, and in many ways, they were just a giant hedge fund with some of the stuff that they were buying.
But increasingly so.
Well, yeah, but let me just, the point that I want to make is, and yet they had, subsidized funding, right, at very, very low rates, and it was a shareholder company, to me, that made absolutely no sense. So that was, back in the 90s, and so that would, if one is going to say that that's really the culprit, that took an awful long time for that to percolate. So yes, they contributed, but I think that was sort of out there for a very long time. I think main contributors would be, the way I see it is two things. Firstly, people just forgot about the three basic axioms of banking. And you can strip away all the complexity, you can strip away everything about the products, the globalization, everything else. And if you look, three main things, and we saw it before in different forms, and we'll see it again, I suspect. Just bad lending, poor credit standards. And so people got more and more aggressive in terms of reaching for yield. In some ways, demand created supply. So you had so much liquidity in the system, and you had very short-term investment horizons because of the way the whole system has evolved, where every day everybody's looking at the stock price, and so there's enormous pressures to get your stock price up for investment banks and for banks. Hedge funds, you have monthly performance statistics. Same with private equity firms. You have so much liquidity in the system. Everybody's chasing for that business, and so all that demand creates supply. And the supply is, for example, the mortgages is in one case, and people just started making bad lending decisions. And it's nothing different from what we've seen in the past. We've seen bad lending decisions happen before. In the LBO crisis, for example, in the 80s, right? So that's number one. Number two, again, the excess liquidity and excess leverage. We saw that in the 20s with the stock market crash. So, nothing, in different forms we saw this excess leverage for sure, but at the end of the day, it's the same thing. You can dress it up in different ways and it'll rear its head again, in my opinion. And then unless you are targeting these problems, which people aren't really talking about. And then lastly, of course, the asset liability mismatch. It's just bad, banking when you saw that with the S&Ls and you saw that with the SIVs. It's the same thing, short-term funding for long-term debt. Different form, but the same thing. So I think, we really have to zero in on the fundamentals. Yes, there's a lot of complexity all around it, but the fundamentals were the same. And lastly, I would say we had, most importantly, inconsistent regulation, and regulation caused inconsistent and inconsistently enforced, and that caused what you would call regulatory arbitrage. So it's no coincidence that most of the hedge funds are not only so-called offshore, but most of the hedge funds are in Jersey and in Ireland, where there is no regulation, and that's what causes the situation where you have all of that business being done there because there's A, they can get more leverage, B, they have lower taxes, and so you have a situation where you have banks, investment banks because they don't exist anymore, hedge funds, insurance companies, all doing the same business in some respects, yet all regulated differently because of how they were incorporated or chartered. That makes no sense. And that's what causes this crazy competition where people all, so for example, just the simplest case where you have leveraged lending, where you have a bank can make a crazy loan, way too aggressive terms because they put it in their banking book, you don't mark to market, an investment bank has to market to market. Now, an investment bank doesn't want to lose the business, so they start doing these loans as well. And everybody's chasing after business, which makes no sense. And the regulators helped people go over the cliff. I've got so much more to say, but I don't want to take up somebody else's time.
Well, there were three elements of that response. One involved monetary policy, one involved the housing sector, and one involved the errors of the ways of bankers generally. Regulators, I'm sorry. Maybe we can sort of address them one by one, and perhaps John, particularly on the issue of monetary policy.
Well, I think the other two are more important. So, the Fed's gotten a lot of flack in the recent crisis for exactly the reasons you said, keeping rates low for so long. And it's certainly true that the Fed didn't see the crisis coming. You could compare the Fed to a tourist in London who looks the wrong way before crossing the street and then gets hit by a bus. They didn't see it coming at all. I remember a meeting, I was visiting the New York Fed last fall when the crisis hit, but I consult there also off and on. And a year ago, I guess it would be last February, there was a meeting with Geithner, who was then chairman of the president of the New York Fed. And this meeting was before Bear Stearns collapsed, and the discussion was about how to raise interest rates in the fall when the recession ended. This is 2008. The fall is when things fell off the face of the earth. Basically, federal funds futures markets were predicting higher rates. The Fed kind of was getting optimistic that they had lowered rates enough to withstand the worst of the crisis and that things were going to turn around. Well, they didn't, and so I think you can definitely say the Fed didn't see the crisis coming. Otherwise, we wouldn't have been having that discussion. But that being said, I don't think that the low interest rates were the primary cause of what happened. We've had asset market bubbles in times of high interest rates in the 80s. You mentioned the LBO crisis. Commercial real estate in the 80s was another bubble with high interest rates. The Latin American debt crisis, much of it happened with higher interest rates. So it's not... We can have bubbles without. I think more important were some of the other issues that you mentioned. The global savings glut, just the awash in liquidity. The money had to go somewhere. Deterioration of lending standards and the lack of a regulatory oversight to enforce lending standards. Financial innovation that allowed people to use their houses as piggy banks. That has two effects. One is it makes, levers up the household sector. Second, houses become more valuable because you can always borrow against your house, and it reinforces the bubble and leads to higher housing prices. Declining premia, I don't think risk was priced very well during this entire, the margins that people were taking on loans were low. And the idea that just by spreading risk, somehow risk got eliminated. You pass it around, there's systematic risk you can't avoid. Somebody has to bear it, and it's kind of we trade it around, pass it out, everybody holds a little bit, and then, all disappears somehow. It didn't disappear. So I think all of these factors contributed to high housing prices. High housing prices led to, loans and mortgage-backed securities. We can talk about levering up. I'm sure that we'll get to that. But I don't think that the Fed was the instrumental thing. If you take the Fed out, I think we would have seen something fairly similar. And we actually have an experiment to this effect, and that's the Bank of England. The Bank of England had monetary policy which was relatively tight. Interest rates were well above the rate of inflation, high real interest rates, but their housing bubble looks exactly like our housing bubble. Their banking crisis looks exactly, well, it is our banking crisis. It's all one big banking crisis. So I think that it would have taken very high interest rates in the early 2000s for the Fed to have burst this bubble, and those interest rates would have run up against the other things the Fed was thinking about. What was the Fed thinking about? It was thinking about outputs below trend, unemployment not coming down as much as they wanted it because of the jobless recovery after the last recession, and they were worried about deflation. Inflation was remarkably low, and they didn't want to get into a Japan-like situation. In the early 2000s, we're all worried about being Japan, and the irony is that by keeping interest rates low, trying to spur the economy to get out of being Japan, we became Japan like a few years later. And so, fortunately, they're learning to speak English, so we don't have to learn Japanese. But, that's our problem.
But John, are there things that the Fed should have been paying more attention to through that period?
This is 2020 hindsight. Yeah, if I was today and I got to go back in time, like in one of these sci-fi shows, I would whisper into the guy's ear, your models don't have a financial sector. But monetary policy, the way you run policy is you try to balance risks. There's always arguments for higher interest rates, and there's arguments for lower interest rates. Right now, today, the Wall Street Journal is worried about the value of the dollar and saying the Fed should be hiking interest rates because the dollar is falling. Well, you talk to anybody else on this planet, and they're quite happy the Fed's keeping the interest rates low because no one's working.
And that the dollar is falling.
And yes, the dollar falling could be a good thing. That's another story.
And the Fed doesn't even control the dollar. That's not their job anyway.
Well, the interest rates affect the dollar anyway.
Right.
But so they're trying to thread a needle between being too high and being too low. How do you do that? Well, you have to put numbers on what too high and too low means, and for that you need a model. And the problem is macro models are really, really complicated. And what you tend to do is simplify things that don't matter and throw them away and focus on the things that tend to matter. And the Fed was fighting the war of the 70s. Things that mattered were things that were things in the model.
They weren't using the tools of the 70s.
No, they weren't using the tools of the 90s to analyze the problems of the 70s, but we hadn't had a bank run since 1933. And so you don't put bank runs into your model when you haven't had one for 50-some years, and they got blindsided.
But I'm saying to take a step back.
By the bus in Britain. It was a double-decker red bus.
A big one.
Yeah.
In the early 2000s, the Fed thought that, in the way that you described, that they could balance the risks and choose the appropriate short-term interest rate.
Yeah.
Isn't that sort of one-dimensional, and sort of developed was an attitude where you only had to look at the short-term interest rate, only make that adjustment? And when I say they abandoned the tools of the 70s, is that nobody looked at the credit expansion that was going on, or took it seriously, or paid any attention.
We were
to it.
below trend in output. Output was below trend, so the output measures were saying lower the interest rate. Inflation was remarkably low. Their credit expansion measures were not showing up in long-term rates. They weren't showing up in inflationary expectations.
But they were
and those are the two things the Fed looks at. So.
But they were showing up in the quantity of credit and in asset prices.
Yeah, and Bernanke blamed the Chinese.
Yes.
Yes.
Can I challenge something that he said?
Okay.
Okay. So you said the Bank of England, well, it's not low interest rates, and then I want to make a comment about something you just said. It's not low interest rates because the evidence is that Bank of England kept their rates high, yet they're in the same soup that we're in.
Yeah.
But I'm not sure that I would agree with that statement, because the Bank of England, and the money supply and the GDP of England vis-a-vis the U.S. is dwarfed, right? And so of course they're going to be largely, as is the whole entire world, affected by what happened with the U.S. So I don't think it's...
No, but the housing...
I wouldn't see a cause... Yeah, but they can get money from... They borrowed... That's the whole carry trade, right? They can borrow from... And because of the globalization, people borrow in U.S. dollars. And that is the carry trade that people are worrying about right now. You borrow in U.S. dollars because rates are lower than in the U.K., and I invest in the U.K.
But mortgages in the U.K. were in pounds, right? The housing bubble was driven by people borrowing in pounds, buying houses.
I understand. But to say that the evidence of that is not the low interest rates is that the UK had higher rates, in my mind, it doesn't necessarily follow, because there's so many of the dynamics going on, and the US is just dwarfs the UK in terms of the effect of our low interest rates on the global economy. To me, I wouldn't necessarily walk away and say, okay, true, the rates didn't matter.
No, I didn't say they didn't matter. I said all these other things mattered much more.
Okay.
Let me help Kim get a word.
I'm going to jump in, and I have a different way of jumping in. I was looking at the walls here, and I forgot this one. I missed it, but I was thinking these walls are rather barren, and they're actually quite useful because they help you. They ask you to simplify the problem that you're looking at. We've created a list of things that are contributors to the crisis, and they probably all contributed in some way in different degrees. But it's useful to step back and, like these walls, think about what's necessary. What had to have happened to get you this crisis? It's not easy to answer that question. It is easier to answer the question, what's sufficient to get you this crisis? And I would tell you what was sufficient to get you this crisis was a loss of capital in the banking system. If you start with that premise, that the loss of capital in the banking system is what drives this crisis, you can go backwards, step by step, to ask what contributed to the loss of capital in the banking system. And the reason that the loss of capital in the banking system is sufficient is, as soon as you have that, a lot of the things that you observe in the world around you happen. We get a liquidity crisis because counterparties don't trust each other. We get a rush to deleverage, to reduce the balance sheets of the banks because they don't have enough capital to support it. Whether it's observed capital or regulatory capital, one way or another, they have to respond to the fact that they've lost capital. Intermediaries matter, and one of the things John said was he would whisper in the ear of the central banker, you need a financial sector in your models. One of the things you need to model is that intermediaries behave with leverage different than households do. When households have homes that increase in value, they actually seek lower leverage. They don't go out and borrow more because their houses have increased. But if you look at broker-dealers in the United States and other highly leveraged intermediaries, in fact, their leverage goes up when their asset prices, when their net worth goes up. They try to hit a leverage target. And that's going to be very important for their behavior and for the behavior of the financial system. So when capital goes down, instead of having this virtuous circle of everyone bidding up prices, we try to go the other way. And we find that liquidity disappears. Liquidity disappears for counterparty reasons. It disappears because of increased volatility of assets. It's more costly to make markets. There are a whole lot of reasons. And you get into two spirals that are destabilizing. A liquidity spiral on the downside and a deleveraging spiral. And they reinforce each other. They are not stable. This is not a world in which a falling asset prices leads to more buyers because they see the prices low. It leads intermediaries to leave the system. That's what's missing from the model. Now, if you believe that there was a lack of capital in the system, that was what was sufficient to trigger the crisis, ask yourself how that happens. And what the clear argument would be is some asset on the balance sheet of many key intermediaries declined in relative value. And that's what's critical. We've had periods when asset bubbles have burst before. We've observed almost no impact on the economy. In the early part of this decade, the tech bubble burst and equities collapsed in price, household net worth declined by $11 trillion in the United States. That's 10 times larger than the entire size of the subprime mortgage market. The decline in value in equities in the early part of this decade was 10 times the size of the entire subprime mortgage market. But why didn't it generate the kind of reverberations, the echoes that we observed in this crisis? Because it wasn't on the balance sheets of the intermediaries that made up the system. So their capital was not impaired, unlike Japan. We got Japan because our intermediaries, and many of them in Europe as well, put these risky assets on their balance sheet, and it impaired their capital. So why did that happen? One of the questions about why intermediaries allowed subprime to get into their balance sheet, we can discuss that for hours. But subprime, and this is the last point I wanted to make, subprime by itself, by definition, is a systemic bet. Unlike most assets, subprime mortgages are highly linked in their performance to the underlying asset price. When people borrow into the subprime market, they're almost always dependent on the ability to refinance in order to maintain their ability to pay, because at some point along the way, 2 or 3 years out, their interest rate will go up on a subprime mortgage. They often can't afford it. They're counting on the ability to refinance. The banks that were issuing those subprime mortgages to them were effectively offering them puts on the value of their homes, options to, at some point, to say, if my home doesn't go up in value, making it possible for me to refinance, you, the bank, are going to own that home. And what's systemic about it is it's quite likely that all those puts are going to come home at the same time. That they're all effectively bets on the rising nationwide house price index. And for 70 years, one of the key facets of this crisis is for 70 years, nationwide prices in the United States rose month after month after month. Even you go back to 1987, the equity market crash. House prices rose. 1998, LTCM, the emerging market crisis, house prices rose. 9/11, house prices rose every month. It didn't matter until this episode. And almost as soon as house prices nationwide stopped rising, subprime mortgage defaults surged and the crisis was initiated. That, to me, is what was sufficient. Now, whether we have to tell a story about excessive monetary accommodation or whether we have to tell a story about bad risk management or bad regulators, all of that's somehow built around this infrastructure.
So you have the smoking gun.
That's it.
And that's the smoking gun that led to the impairment of capital of the financial intermediaries. Why did that develop? Why did the gun go off?
Well, the first question I think you've got to ask is, did the intermediaries understand that they were engaged in a systemic bet? And my own personal judgment is relatively few people did understand it.
The ratings agencies did not.
Yes. But if you ask yourself today, were there people out there who did understand that subprime by its nature was closely linked to the underlying housing prices? I think the answer is yeah, there were people who understood it. They probably would not have claimed, though, at the time that it would lead to as wide a problem as it did, because they didn't understand how deeply embedded these assets became in the balance sheets of the banks.
I don't think the banks understood
Banks
that.
didn't own this stuff, but let's back up. Because that's not really what happens, right? That's the whole criticism of securitization. Securitization, the so-called originate to distribute, and the criticism has been, you guys just originate this stuff, get it off your balance sheets, and you don't care what happened. And therefore, we want new rules to say you have to have, quote, skin in the game, you have to keep some of it. So by definition, people recognize that banks didn't own this stuff. In my mind, you're correct about, the asset prices, i.e. the houses, but what really happened was you had incremental leverage on top of that, right? So you have a housing sector where these guys have already levered themselves. And now what happens? You pool these things together, you securitize them, you sell them. Okay, fine, there's some leverage there. But then what happens? The guys that buy them, hedge funds, other institutions, finance those with leverage. They borrow more money. So it's leverage on top of leverage. It's not, so if those homeowners had bought all of those homes and it had the banks or the originators kept that on the balance sheets, I submit we wouldn't have had the problem that we had. The reason we had the problem that we had is because they didn't. They bought them, securitized them, sold them, and the guy that bought them leveraged them, and the guy that bought them from him leveraged them again. So there's multiple layers of leverage.
And many of these...
So then what happens? So then we have Northern Rock as an example, which had nothing to do with capital. It had to do with bad asset liability mismatch. And you had Spain, who has counter-cyclical capital requirements. They have lots of capital, and they blow up. What happened was, now all of a sudden you have a trigger, and then people start to delever. And when you start to delever, because of mark-to-market, you have this accounting, this perverse thing with accounting that says, okay, I have to hurry up and sell this thing because this guy just called me for some more margin. So I sell it. Now what happens? That triggers a downward spiral in prices because as I sell it, I push the prices down. Everybody has to mark their stuff down further. The more I mark it down further, now you have to give me more collateral because now margin call again, and so on and so forth. So what happened was the leverage on top of the housing bubble, or the housing, the mortgages, and mark to market. So these institutional things that had, the intent never was to create this issue. And in the 87, for example, that's one thing that I have been talking about for a while now. In 87, we had circuit breakers. So stop,
In the stock market.
Correct. In the bond market, there is no such thing as a circuit breaker. That's why things way overshot, and that's why things got way out of control.
I just would challenge you about the argument that it wasn't on the balance sheets. The best example of the evidence that it was on the balance sheets is the UBS mea culpa. UBS is the only major bank that I know of that was forced by its regulator to come out and say, why did they have a problem? And they published a piece back in February of 2008 in which they revealed how large the losses were from their efforts to gather and warehouse mortgages for the purpose of building up CDOs for sale. That desk alone, which probably only had a few dozen employees, lost $20 billion worth of net worth for the bank. I don't think that that's...
These are things they were holding temporarily.
Temporarily, which means
Yeah.
4 to 6 months of warehousing. So I agree with Madelyn in the following sense. You probably need leverage to make this an issue. But but go back a step. If you have a certain amount of net worth in the banking system and you take losses on the assets that undermine that amount of net worth, in fact, think of it, subprime, maybe $1.5 trillion total. What was the total capitalization in the U.S. banking system before the crisis? A very similar number. So if you lose all the value in an asset that plays an important role on the balance sheets of your banks, just like Japan in the 1990s, you're going to get into a situation that can have liquidity crisis and sustained impairment of the financial mechanism, which makes it very difficult to recover, even in a period when you're coming out.
But you raise a good point about the CDOs, which was my point earlier, and that is demand created its own supply, right? So you have these CDO managers who wanted, both on the residential and also on the corporate, the leveraged loans, which, by the way, for some reason no one still talks about, which to me is the next shoe that's going to drop.
No, FHA is the next shoe.
Sorry?
FHA is the next shoe.
So you have these CDOs, right? You have a CDO manager who has buyers because you've got all this excess liquidity in the system and they want to invest. So the CDO manager is running around looking for collateral to put into these CDOs. And so it came in the form of mortgages, which encourage more and more origination, which encourage worse and worse lending standards, because I have to get this guy to make, to take this loan. And also in the mortgage space, as well as in the leveraged lending space. Good portfolio theory said that you need to have a balanced portfolio. So what you looked at, what these CDO managers would look at in the leveraged lending space was, oh look, we don't have this industry, we don't have that industry. Go to the sponsors who had tons of money to invest because of the excess liquidity, and said, can you lever up this and this and this kind of corporations, because we need that to be well diversified. Well, guess what? Those corporations didn't have leverage on them to begin with, for the very reason because they weren't the kinds of corporations that lent themselves to that kind of leverage. So it was demand creating the supply.
But to a large extent, these created securities would come back and sit on the books of banks.
Or bank-like institutions.
Or shadow banks.
Shadow banks.
No. Pension funds buy the loan, and insurance companies buy the loan, and hedge funds. So banks.
Hedge fund.
Yeah, but that's not a shadow bank. Banks or investment banks, and that's the whole criticism. They don't warehouse this. They don't keep the stuff.
Well, let me show another way in which the impairment of an asset that was perceived as reliable can lead to a liquidity crisis, and did in this episode. Over the last 20 years or so, the demand for collateral in international financial transactions has grown enormously. When derivative markets expand, there's a need for collateral to back up swap agreements and other kinds of over-the-counter agreements that are made among financial counterparties to make those transactions feasible. The need for collateral was growing faster than the classic low-risk collateral such as treasury bills and bonds. So what became used as collateral? One of the things that was typically used as collateral was the so-called high-grade mortgage debt. What happens when you suddenly wake up one morning and say, this debt, which people thought was of high value and impeccable credit, might not be? What you find is that a market that was essentially informationless, it needed no information about that debt, suddenly needs a lot of information. The haircuts on super senior AAA mortgages went from zero in August of 2007 as high as 50% 6 months later. Effectively, that means that you took away half the value of the available collateral for the liquidity market, for the repo market. The repo market had to shrink. It was an enormous shock to go from an equilibrium where you needed no information about the collateral to one in which suddenly you had to know what it was worth and value it in a world where it was highly complex and highly opaque. The liquidity shock was almost inevitable once that happened. The equivalent story goes back to something written in Economics in 1970, George Akerlof's Market for Lemons. Suddenly, there were lemons in the repo market, and no one knew for sure where they were. That meant you stopped trading, and the market disappeared.
John, you wanted to add something? No, okay. You were writing furiously, so I thought you were getting ready to roar ahead. Maybe we should turn our attention to solutions rather than just looking in the past. I know when I first discussed this session with Hillary, she said, well, don't just reflect on what's been. You've got to be optimistic, even though it is the dismal science. So maybe we can look forward to the kinds of regulatory inadequacies that are behind us and talk a little bit about the changes that ought to be made that might help us avoid these solutions, these problems in the future. There's lots out there, some of it very specific. You just open a newspaper and there's all this yelling and screaming about this salary at Citibank and that salary at Bank of America, but I don't think that's worth talking about. There are some broader issues, which have already come up here, about the design of a financial sector. What is a bank? How does a bank differ from other financial institutions? Should it be different in the eyes of the regulatory structure, and so that things don't fall in the cracks between them so that there's not quite so much regulatory arbitrage, and that might help us avoid things in the past that happened in the past. There have been lots of solutions talked about. Mervyn King, who's the governor of the Bank of England, wants to separate the public utility aspects of banking. You know, my checking account is like my Con Edison gas bill. It's a public utility. From the casino aspects of banking, which are the gambling activities that we've been talking about all together. And so that banks would be what we call narrow banks, and that financial casino would be taking place someplace else. It's an old idea. It came up many, many years ago. I've always just dismissed it as being silly, but here it is that the governor of the Bank of England seems to take it quite seriously. Similarly, there's lots of talk in this country about bringing back the Glass-Steagall Act. You can't very well separate commercial banking from investment banking because, as Madelyn mentioned, there are no investment banks anymore. They've all become banks. But there's a suggestion that perhaps we should bring back Glass-Steagall as a way of separating certain parts of the financial industry and certain functions of the financial industry from other functions of the financial industry. Sounds good, but I'm not quite sure anybody would know how to make that separation. What kind of structural changes in the financial system really need to be put in place to prohibit or prevent some of these problems from arising in the near future?
John.
Well, I guess I distinguish between two sides of the problem. One is the beforehand. What are the rules of the game, and how do you want to lay the rules of the game out? And that has to be very clear, because it's very hard once things get going to tell bankers not to do something they're doing. They're making a ton of money. They're earning more than you are as a government employee. And so it's really hard you want to say at the beginning, this is the rules. And we have rules, the Basel Accords, but we need to adapt them to financial innovation and the new situations. Then I'd just say the other side's the end of the game, which is we don't know how to shut this banking system down. When you have a problem and an institution is in trouble, there's so much interconnection between all of the different groups that if you tried to shut down a financial institution for a day, I mean, what we used to do in the 1800s is there was a banking crisis, and J.P. Morgan would shut everyone down and get everyone together in a room, and they would open the books, and you're solvent, you open up tomorrow, you're insolvent, you're closed, you're solvent, you open up tomorrow. You shut these guys down for a day, though, and the lawyers get involved because there's millions and millions of dollars of contracts that are coming due every second, and somebody has to settle these things. You can't resolve this. You need some sort of resolution authority. So I think that would be the easier thing to do, would be a resolution authority. The harder thing to do is how to design rules of the game that avoid excessive risk-taking, excessive leverage. I mean, defining excessive is the hard part there. Maybe you guys have more ideas there.
This whole resolution authority that's been talked about, this whole sort of concept of defining or designating certain institutions to be too big to fail and others not.
Let me just interrupt. We developed a relatively good resolution authority in this country after the S&L crisis.
We thought we did.
No, we do, because it's developed well to deal with all but the biggest banks.
Right.
Which at that time didn't exist. Remember, in the last 2
That's right.
years, some 200 banks in this country have been closed down.
Understood.
And
They just left
our
out the bank holding companies.
Yeah, and our ability to do
And
that
the
and
energy.
resolve it
Yeah.
both fairly, legally, and without being disruptive, that's something that's been quite successful in the last
Yeah.
2 years. But going back to when that was put in place after the S&L crisis, you didn't have, to the extent that you do now, these bank holding companies dominating the industry. You didn't
Right.
have the consolidation of the American
Or a
banking
company
industry.
like AIG, which is a huge company with many profitable businesses and has a small little arm in
Which was
London.
completely off the horizon at that time altogether, if it existed in that way
it
at
lost
all.
the whole firm.
So resolution authority for these institutions that are too big to fail, or viewed as being
Too big to resolve.
It's too big
They
to
all failed.
resolve. They failed.
Yeah.
But there's got to be something, it can't be too big to resolve because we've got to get ourselves out of the situation. How do you do that?
Yeah, but hold on one second, because I brought this article that I was reading today in the Financial Times, which I couldn't believe. This latest bank that failed over the weekend, tiny bank, $11.2 billion in assets. That is absolutely nothing. And what all of a sudden people are realizing, and I can't believe the FT actually even prints this, is that we have to hurry up and think about how to change the law to do this. And it's the United Commercial Bank seized on Friday. And let me just read this. It's just mind-blowing to me. It says, okay, the real complexity of seizing this $11.2 billion bank was that it had a heightened international scope. It had one branch in Hong Kong and a subsidiary in Shanghai. And so this guy, who's a senior policy advisor at the FDIC, said that we need to, quote, have laws to harmonize this. And he's also, as scary as this is, a co-chairman of the Basel Committee's cross-border resolution group. Now, $11.2 billion, Lehman Brothers was $700 billion balance sheet. And of course, international scope is enormous, which we were talking about before, about how many, legal entities.
Yes.
And so the reality is, do we have a resolution process? Of course we don't. We have this for very small institutions and for U.S. domiciled institutions. And the world has changed since the 1980s, that's for sure. And globalization. And so, people haven't, in my mind, there has to be a timeout, and you have to have a stay in terms of bankruptcy, if there is such a situation, because the case of Lehman Brothers, we have all these different legal entities, and because of regulatory arbitrage, you've got a position that is, for example, booked, the long position could be in the U.S., and the hedge is going to be in the UK. The reason is the hedge could be a CDS, and of course, who does CDSs? The counterpart is going to be a hedge fund, so that's going to be booked in the UK. And now what happens? A perfectly balanced book immediately becomes totally imbalanced because everybody's grabbing and no one's, caring about the totality. So the destruction of value is enormous. So that has to get resolved, and people. 14 months after the bankruptcy, they're only the light bulbs going off in their head for an $11 billion bank is saying, you know what, we have to think about how to handle this. It scares me to think that people haven't even thought about, the most important fundamental issues.
Do you have any thoughts about how to put in place a resolution authority or the equivalent of a bank holiday for globally interconnected institutions?
I think that the reality of that happening is de minimis, because we can't even come up with an agreement among and across ourselves in Europe. I think, by the way, Europe's done a good job in terms of trying to harmonize themselves, coming up with this, oversight at a high-level group. And in the U.S., we can't even, among our regulators, decide that. Never mind how we're going to handle this thing across the ocean. So I think we have to realize that it is a global. The world has become globalized, for better or for worse, because of the internet, because of money moves so quickly, and we have to sit and play better with our colleagues in Europe. But we have to get our acts together even in the U.S. We don't have any thought really about who's going to be the major regulator. It's going to be the Fed. No, it's not going to be the Fed. We can't even resolve that. And I think, going back to the point before about you're saying, well, we don't want to just talk about what happened. Let's talk about what we should do for the future. We have to agree about what was the cause of what happened to begin with. Because unless you all agree about what happened and why it happened, we can talk about it all day long, but we're not going to come up with a solution to how to prevent it to begin with, because what's the it that we want to prevent?
I'm going to just jump in. I'm going to take the opposite tack to the one I did at the beginning. The beginning approach was to say the beginning was to argue that to understand the crisis, we need to actually simplify and look for the basic elements of what caused the problem, and then go backwards from that step. Now we're asking the question about what solutions we should be looking for to prevent or to mitigate future crises. And I think for that, I'm going to argue that we're going to have to do a lot of things, because it's unlikely that any one thing is going to be sufficient. And part of the reason for that is that, A, it's so complex, but B, we're dealing with a sample of one. Every single solution that we propose is based on a sample of one observation. If we had 1,000 such crises, we might be able to go back and say, we can address 657 of them using the following technique. We don't have that sample available to us. We're going to make mistakes, and we're probably going to need a lot of tools to address them. I would agree with John that if somebody said to me, what's the first tool I would like to have? It's resolution authority. But for the reasons that Madelyn's suggesting, I think it's going to turn out to be of limited effectiveness. Basically because you need global resolution authority. And the ability to, we don't have identical bankruptcy rules across states in this country, let alone across countries in the world. And the difficulty of getting legal resolution for highly complex financial institutions is going to be enormous.
How about the idea of the living will?
It's a start.
No,
it's a
but
start.
that doesn't help you too, because it doesn't go across the legal jurisdictions. But you know what?
The reason I'm going to just explain what it is. What Paul's suggesting is that banks be required to identify in advance for others, including their regulators, exactly how they should be unwound in a crisis if their net worth is falling to a dangerous level. It's a useful idea, but I think what you'll find is it's untested until the event occurs.
But it's irrelevant almost, because you can say what you want to say internally in your institution. Okay, this is what we're going to do with London, this is what we're going to do with Tokyo, and so on. But did the FSA and the Bank of England agree? No. So
London shut down all the banks in Iceland when they won.
Exactly, and the other issue is then, of course, the big concern is, well, then who's going to pay for this? Because taxpayers, and we're politicians, and so, we're in London or we're in, Hong Kong or whatever. So it's not a simple thing. But let me take it one step further, and it's not just across legal jurisdictions, countries. It's not even just across states. Even in New York State, at Lehman Brothers, as another example, the holding company is treated one way, and the broker-dealer is in a so-called receivership, and the holding company is a debtor in possession.
Yeah.
So even within the U.S., it's like everybody's grabbing for himself.
John, my point is only it's useful, but it's probably not by any means sufficient. So if you ask me what the second thing I would want is, something that addresses systemic risk, both in its cross-sectional dimension and its time dimension. Cross-section is about common exposure. It's about the exposure of financial institutions to various specific risks like subprime. And time dimension is about the cyclicality of behavior of financial intermediaries, the fact that they get leveraged in good times.
The regulatory authorities in this country had every reason, though they didn't see it, as you said, and every capability, legally, to pay attention to systemic risk. Now we're going to turn back to these very same institutions and say, your job now is to pay attention.
Here's the good news on that front. As John was pointing out, until just a couple of years ago, or until now, there were virtually no financial sectors built into macro models. And if you were at the Federal Reserve and you were working in the prudential side of the business, you were a nobody. That's probably not going to be true in the future.
Glamour profession, bank examiner.
But the second thing about it, the second thing is clear. The Federal Reserve now knows that it needs more tools. The interest rate tool is not enough.
And more expertise.
It needs macro-prudential tools to address these cross-section and time dimensions of systemic risk.
But it also needs to have a clue about reality, because also in February of 2008, I was asked to come down to the Fed, and we had a meeting among the so-called senior supervisors, and this was the supervisors of the U.S., and the UK, and basically all the supervisors around the world. And they all came, big conference room, and they had a little study that they did among themselves, and they wanted to present their findings to the street to say, to keep people in the street to say, okay, we have confidence in your opinions, and here's what we observed. This was in February of 2008. Here's what we've observed, and here's what some guys did well, some guys did poorly, and so, kind of patting themselves on the back and saying, okay, this is what we need to make sure that everything stays, in good shape. And of course, a month later, not even, Bear Stearns blows up.
March.
And, so how clueless?
Whew, it's tough.
But, can I just say something? But having this resolution kind of process all sort of pre-laid out. The only thing that scares me about that is then it almost creates, in my mind, a moral hazard in and of itself. By saying, okay, these are the guys that are too big to fail, these are guys that are so-called systemically important, not systemically important, and then that makes them do things again that would, in my mind...
Let's see if we could agree on on one proposal. We probably agree that leverage is pro-cyclical. I think we observe it. We see it all the time. So why don't we ask as a rule of the game that capital requirements be pro-cyclical? So that we're not using interest rates to lean against the wind, but we're using a new tool. We're using a tool to lean against the wind.
Even in the same institutional context that exists.
You don't mean pro-cyclical, you mean anti-cyclical, because it's been pro-cyclical.
Well, in the sense that in good times, capital requirements rise.
Yes, that's
So that you don't have to de-lever as fast.
Sorry?
So you don't have to de-lever as fast.
And you don't lever as fast either.
Which is what Spain has done.
Yeah, but there are proposals out there to do this in a better way. Another thing that's useful, Paul, that is, again, part of the crisis. There is an academic response. There are people actually coming out and developing mechanisms for measuring systemic risk. And if we don't measure it, it's not there, and we don't know about it. And now that we're starting to think about how to measure it better, we at least have a chance of addressing it.
Yeah, but you know what? Take operational risk. What operational risk is measurable? The operational risk that's going to blow you up, you haven't seen before. And once you see it, if you're gone, it doesn't help you you have a data point, right?
No, and that's a good point, because Basel II required banks to measure operational risk. And I had a former student who was doing that for Citibank, and I had him come to class to describe it. And he gave this wonderful lecture for an entire class period, and I had no idea what he was doing. Right. Because it's so elusive a concept.
Totally.
I just didn't know what they were doing. He was fulfilling Basel II because Citibank needed to do it. But I don't know it substantively. Let me turn to one last question, and then I want to open it up to the audience. We're here in this beautiful NYU Abu Dhabi headquarters building, and I thought we might spend just a few minutes thinking about how we connect to that part of the world. The Abu Dhabi sits on a great deal of oil wealth. Other countries in the region do similarly. They have either very large sovereign wealth funds or investment funds or foreign exchange reserves. Many other countries, non-oil producing emerging market countries, have developed enormous foreign exchange reserves and continue to do so through this crisis. To some extent, those reserves have been pointed out in this discussion as being somewhat responsible for where we are in terms of creating the savings glut, as Bernanke called it in 2002. What's the responsibility of the rest of the world, the emerging market countries, the countries sitting on enormous reserves, whether they're coming from oil wealth or from just accumulating foreign exchange reserves, and not so much the responsibility in the sense of being responsible for where we are, but what's their responsibility to the global economy moving forward in terms of making sure these kinds of things do not happen again so quickly.
Round of silence is the answer.
I would say they were, for the most part, a stabilizing factor. And
the sovereign wealth funds.
Yeah. While it's true that there was this excess liquidity, it's not their fault that they had the money, and they were just trying to invest it. They are, I think, probably the more prudent of investors. They are. And so I think they weren't one of the culprits in terms of sort of the chasing, reaching for yield guys creating the demand, because excess liquidity surely did that, but I didn't really see it out of the sovereign wealth fund. They're pretty conservative investors, frankly.
They saved Citibank.
And they were a stabilizing factor by either giving, sort of investing in some of the institutions that were falling, and or at least people having the thought that, well, perhaps they are in the in the background, and maybe they will. So I can't think of any way that they were part of adding the fuel to the fire.
Okay. John, Kevin?
Well, look, I think I want to be careful, but I think if we go back to this argument, the Ben Bernanke global savings glut argument, I don't think that's actually satisfying in the following sense. To blame savers for saving too much as a source of the problem. It does tell me that if you observe that the central bank in the country where they're worried that they're receiving too much savings should be looking at financial conditions and setting their policy rates.
Right.
But it is still the case that if you persist despite market pressures to try and maintain high savings for mercantilist reasons, that you contribute to instability in the world. I don't think that's true in countries that have large natural resources, but I think there are countries that pursue mercantilist policies, and they are destabilizing.
If one of the problems was that there were too many too big to fail that failed, the question is, A, should it exist, or should it be like, if you're too big to fail, it shouldn't exist, or you should be totally regulated, which means you are a utility.
Mm-hmm. I think that the answer that was given up here is that effectively, well, forgive me for speaking for others, effectively we agree in the following sense. We think the problem is not that they're too big to fail. They did fail. The problem is that they were too big to resolve quickly in a way that was efficient without doing spillover damage to others, innocent bystanders. And what we want to see is a world in which it's easier to resolve them quickly so that if they fail, they receive the normal economic...
And then you can allow them to fail.
Exactly.
But Kim, there's another element to that.
Yeah.
These very large institutions exist. And I think what's being suggested, and I would be partial to, is breaking them up at some point. There's
exactly what I'm proposing.
There's very little evidence that there are such enormous, wonderful economies of scale to having institutions the size of either Goldman or Lehman or Citibank or Bank of America, that the consolidation in the American industry, which just took place just in the last 10 years, wasn't necessarily an improvement in the American financial industry when legal, what we viewed as archaic legal reasons kept that consolidation from occurring. Limitations on interstate banking, which we all thought was funny old, laws, kept that consolidation from occurring until the last 10 years. American financial sector seems to be humming along pretty well despite those archaic laws, and maybe we should break up some of these institutions.
I'll even add to that. I would say that no single management can effectively manage a consumer-type banking with branches and investment banking. The skill set is so different, the compensation is so different. I grew up in Chase when it was not even allowed simply to go upstate New York and buy a bank. And
the only problem I would suggest to you is that the traditional ways in which we broke things up, the Glass-Steagall breakup, may not address the issues that we care about. And I agree with Paul. The evidence for economies of scale and scope is not very strong. On the other hand, and we know also that there are costs to having very large institutions that are badly managed. But I'm a bit more agnostic about knowing what the right solution is. And my answer is, at a minimum, we want to be able to say that an institution that has made so many errors that it's failed, we're going to try and shut down in a way that doesn't disturb others.
But it's ironic. One of the solutions has been, let's put them all together, right? So you've got Bank of America, okay, help us out and buy Countrywide and help us out and buy Merrill. And so now we're even bigger. But it's not just about size, because people, in my mind, forget about different types of too big to fail. So, for example, you mentioned Chase. JPM, in my mind, forget about the fact that it's a bank that takes deposits. It's an investment bank that takes big bets. It's a counterpart. But it's also the financial plumbing of the U.S. economy, and I don't think people realize that. They are the clearing for Fedwire, all non-DTC eligible trading, and they are the main tri-party repo clearing agent. And so talk about a systemically important institution. So, no one could ever let them fail because, we'd have to close the doors.
No, but that addresses Kim's
But that
point.
should, in my opinion, should be broken
There are
away.
no economies of scope from that clearing activity.
I think that should absolutely be broken up.
Oh, okay.
Makes
Then we
absolutely no
agree.
sense.
Then we're in agreement.
But we have to also be careful about how we make things break up. So, for example, right now in Europe, there's this crazy, it's almost a punishment. So, Nelly, the commissioner there, is saying, ING. How ridiculous is that? And the idea is not just because of, and also RBS, and also Lloyd's. And what they're doing is they're saying, we want you to break up because we don't want you to have too much. We don't want to have concentration, not because you're too big to fail, not because of systemic risk, but we want to help competition of the smaller guys. So we have to, again, what are we trying to fix? Exactly.
Is it enough to break off commercial banks and investment banks, or given the amount of financial intermediation that's being done outside of the commercial banking system, do you have to break everyone up? Would you have had to break Lehman up before this?
Look, there have been proposals going back to, Henry Simons, for narrow banking, for having a world in which the only portion of the banking sector that we would protect is the payment system specifically, and to have banks that only function to provide payments. They take deposits and they facilitate payments to the system and do nothing else. We get rid of we get rid of deposit insurance, get rid of all the other aspects of government intervention in the financial system, but we protect that little narrow public utility of the payment system.
But the crisis happened elsewhere.
Now, here's the problem. That idea is an old idea, and it's been around for a long time. The problem is, and this is one of the insights of Charlie Kindleberger, when it comes to a crisis in the rest of the system, do you think government's going to stand around and allow the unemployment rate to get to 20% because they said there was a rule in place where we're not going to intervene to protect these other speculative risk takers? The odds are that there's going to be a lender of last resort for these other organizations. So if you don't plan it in advance in a way that makes sense and creates credible rules, it won't work.
But functional separation, which was possible in 1933 with Glass-Steagall, when you could tell, J.P. Morgan to go one way with Morgan Bank and one way with Morgan Stanley, I don't think it's feasible at this time, given the complexities.
John's point is that it may not be the separation that matters.
Yeah, because
It's
the
the
levered
size.
up, you have Lehman levered up 30-1.
Right.
And there's where the propagation and multiplication through the system is happening, not through J.P. Morgan. They were solid.
Well,
So you go back to the fundamentals that I talked about in the beginning, and that is, what are the fundamental axioms of proper banking? It's leverage, it's asset liability mismatch, it's credit standards. Because however you're organized, if you do that badly, you're going to blow up.
So you need to
Back
regulate
the audience
everyone.
For another question, perhaps, sir?
We've had some great retrospective and normative discussion. Looking prospectively, what's going to be the next shoe to drop? When will it drop? And what will be the net effect?
FHA next spring.
He's
No,
sure.
FHA has stepped into the subprime lending market. Basically, the mortgage market has disappeared. All mortgages are held by the U.S. government right now, either Fannie Mae, Ginnie Mac, or the Fed. But the interesting party there is FHA, because they've decided to take over the subprime mortgage market. For the last 2 or 3 years, they've been making 95% loan-to-value loans at 600 FICO scores to people who are now 150% underwater. 20% of their loans from 2008 are already 90 days past due. They are probably going to run out of money sometime soon, and that's the next shoe. And fortunately, they're insured. They're the U.S. government, so we insure them.
Okay, you want a specific question, you got a specific answer. Anything else? Another one, sir?
How realistic can we expect it to happen when so many institutions are too connected to fail?
I didn't hear the question.
I didn't hear it either.
How realistic is the expectation of reform when too many institutions are too connected to fail?
Connected, you mean?
Correct.
Connected as in the Goldman, United States of Goldman.
No.
Yeah.
And also the
Too
politics
connected to
behind
fail.
the,
I thought you meant connected to the government.
The debate of free enterprise and how the regulation is suppressing free enterprise. And so I think this is a it's sort of, it's a problem that goes on itself afterwards. You're not realistic to expect any progress in reform because you have to be feeding on this as well.
Well, I think that relates to just the prospects for reform in a highly charged political environment. Is there any reason for optimism?
The best argument for optimism is the advancement of knowledge.
No, the best argument, we've never been in a recession that hasn't ended.
No, but for optimism about regulatory reform. If the recession ends, you're not going to get regulatory reform.
Well, as I said,
Optimism in general.
No. I think. Look, when you're ignorant, the chances for reform are tiny. When you're learning more and developing better understanding and knowledge, and that is happening in this crisis, at least there's a chance that some future policymaker will pay attention to some defunct economist who might have figured out the problem.
there is a possibility, I think, that once the healthcare legislation is out of Congress's hair, that the congressional committees have some capability to sort of begin looking at these
But
things
there's so
seriously.
much politics involved in it, and they don't understand the issues, and the regulators aren't exactly, up to speed, because if they were, we wouldn't be here to begin with, in my mind. So it's not clear to me, how effective, and of course, even among the regulators, there's so much politics and jockeying for positions.
Between themselves, amongst themselves.
The SEC, the CFTC, FDIC, the Fed, they're all, it's a power grab, right? And then, of course, as I said earlier, because of the internationalization, the international scope, you have to have the agreement not only among ourselves about A, what to do, B, who's going to do it, but then, of course, across the universe. And for all that, that's like asking the sun, the star, and the moon all to line up at the same time.
It's kind of like global warming.
I think it's not going to happen.
It happens.
But my concern is we'll get some kind of regulation that's just not going to be, effective. And that'll just cause, it's almost like a big balloon, and you grab it over here, it just pops up over here. If you have a regulation that, again, doesn't really address the heart of the issues, you have smart people in the financial industry who will just argue away. And that's what we had before.
Okay. Sir.
Should we pay regulators more to maintain track better people?
Yes. Absolutely. Absolutely. Because if you look at, they're trying to chase after the brightest minds, and they don't attract people that are comparable because they don't pay.
And the rating agency should pay better.
Absolutely. Absolutely.
Sir.
It's interesting to see that all analysts agree on regulation, but Madelyn said something earlier about New Jersey and offshoring. Is it within the behavior of corporations to go after, to be regulated? They really they want to be unfettered. They want to be, have the wherewithal.
I don't think that that's true, because I think people just want to know what the rules of the road are, and I think people want to know that they are not disadvantaged, that they're in one business and this guy has a different corporate charter, and they're doing the same business, but they're going to have a different rule. I don't think anybody doesn't want a rule so long as it's consistent across all the players and it's an even level playing field. Because at the end of the day, don't forget, people don't want to blow up. And so it's not in anybody's best interest. If you look at Bear Stearns, look at Lehman Brothers. Lehman Brothers, up to 70% already. And people are talking about, we have a great idea. We're going to have compensation be tied to performance. Well, guess what? That's how it was at Lehman Brothers. Up to 70%, depending on your seniority, for the most senior people, up to 70% of compensation was in firm stock. And that stock was not able to be touched for 5 years. So I can assure you that that is an alignment of interest with the shareholders. And so you don't come in, the way the press and the politicians make it out as if everybody comes in every day, they do crazy things and hope to make money at the end of the year and they all go away. That's not how it happens.
No, I think his question, though, was about regulatory arbitrage.
No, you're saying that you don't want regulation. I heard him say you don't want regulation, corporations, and I'm saying that's not true. But they want regulation, A, that makes sense and that's applicable. B, that's consistent across the board. And if everybody is playing by the same rules, that's fine. But don't give one set of rules to this group, a different set of rules to that group, a different set to this group. You're all doing the same business, and now you're going to arbitrage each other away. That's what people don't want. And also, the rules can't keep changing. They have to be consistent.
We're about running out of time, and so perhaps I'll turn to our panelists without annoying them with one of my additional questions and ask whether they would like to make a final comment or two before we adjourn. Kim, you spoke at the beginning last, so I'll let you speak at the end first.
I don't want to sound like Pollyannish here, but I do believe that the experience we've gone through has educated some people. And there are past occasions when crises have led to changes in policy behavior. We had a great inflation in the late 1970s in the United States. We learned from that. We learned to run a monetary policy for 25 years that kept inflation low and stable. I don't think it's beyond our capability to do better. Whether we actually have the political will to do it is another thing, and it's uncertain yet.
Oh.
You said something to the effect of, this has educated people. And I think that is absolutely true, but I think unfortunately it has angered even more people. And I think the angry people, whether it's, the population at large who don't understand, or politicians who want to make hay with that because they want to get elected and they want to look like they're doing something, I think it is unfortunate, because my concern is that they'll come up with something just to look like they're doing something, and it'll be the wrong something that we're doing. I think we need to, for sure, fix the problem. We have to figure out, we all have to agree what the problem was, and then come up with rules, as I said, that are consistent across all of the players. And I don't think anybody would disagree with that, but I think we have to sort of let cool minds prevail and not just have, the anger about, the Citigroup guy getting paid so much money, therefore let's make them sell the only profitable business that they have. How does that make any sense? Doesn't.
John?
The crisis will end. And there will be another crisis.
Yeah.
And we will not anticipate it, except for Nouriel Roubini.
And like crises, all good things must come to an end. So I'd like to thank my friends on the panel for giving of their valuable time to join us this evening. Thank you for joining us. I hope we will see you at future NYU Abu Dhabi events in this room, and I hope you enjoyed the conversation this evening. Thank you.